Hey everyone, this is the Gift team making another video about the investing basics as a quick summary. My name's Kyle Chen, and on the other end here I have Simar Bedi. So we just want to kind of talk about topics of investing basics, kind of summarizing to kind of three main points. So kind of the benefits of investing, the risk and return concepts involving in investing, asset classes, and global markets. So, kind of just want to touch base on kind of the benefits of investing. Now, typically speaking, most people think that, oh, I'm going to be investing. It's kind of a get rich quick scheme. They want to be the next Bill Eichmann or Warren Buffett. But in all reality, is that most investors are people that are looking to create like a cushy retirement savings plan. With the day and age that we are, with how healthcare is, typically people are their life expectancy has increased greatly. So you're trying to save for about 30, 40 years of being retired. And if you're just relying on government subsidies like the CPP, which is a Canadian pension plan, or the old age security check, that won't do that. You won't be able to just survive on that alone. You'll need savings for this. So this is why investing brings in that benefit. Now, most people, especially the risk adverse investors, they typically don't even want to, or I shouldn't even say investors, just risk adverse in general. They typically want to put like a GIC, non-redeemable GIC, probably get 1 to 1.5%. But in the landscape that we are currently in with interest rate policies by our governments, the interest rates are really low compared to what they were in the 1970s or 80s when we were above 10%. So, with that being said, though, unless you're a wealthy individual that has $2 to $5 million in their bank account, the banks won't be offering you a high interest product of anything. So you'll be probably getting south of 1%. So we actually created a spreadsheet where it shows the power of investing, and second of all, it shows the compounding effect here on the spreadsheet. So with this spreadsheet here now, it's very basic here. We just want to show you kind of what can happen. So as here we have the starting capital is $10,000. We have three different types of, I guess, portfolios in a sense. So one is the money market, so your typical GICs at 2%. So we're very lenient on that. 6% is typically what you get for your medium risk portfolio. And for a high aggressive portfolio at 10%, that's typically what you get for an equities or all equities portfolio. Now, let's look at here. So in the column here, interest at 2%. So your first end of the first year, you're expecting a $200 return on your money market product. Now, if you get the compounding effect here, as you can see at the end of year two, it's actually $404. So you do get your $200 plus that extra $4. So that's the compounding effect right there, is that difference of $4. At the end of 20 years here, you'll see it'll be at $14,859. So 2 years from now, you've got about a 48% return, which isn't bad. And you can see also the compounding effect had given you an additional 8% versus what you'd expect if it's just every year 2%, you'd be on average 40% return over 20 years. Now, medium risk portfolio at 6% here. Your first year, $600. Second year, as you notice here, it's $600 plus an additional $36. That's compounding effect. But the power of investing here, end of 20 years, you've gone about $32,000 at that end of the 20 years, which is not bad for a portfolio that has medium risk. And I mean, that's definitely going to get you a lot closer to your investment goals for your retirement versus $14,000 here. Now, if you're in an all equities portfolio here, your average return is 10%. First year is 11,000. Second year, look at that, $100 more plus the $1,000 at the end of year two. But by the end of year 20, you have about $67,000, which definitely gets you a lot closer here to your retirement goal. Now, with all this being said and done, first and foremost is that you need to look at this as on average is what you're looking as in a return. But of course, with reality and how life works out, you'll never get that on ongoing basis that nice 10% return every year. It's probably be 1 year you get 15%, second year you get 5%, and then the year after maybe 20%, and then on the fourth year you might get a decline of like 5% to 10%, right? But on average, you typically will see a 6% or a 10% return on those specific portfolios. Now, kind of with me saying this brings up about the risk and return concept that I'll let Simmer take over here and explain in greater detail.
So the risk and return is one of the biggest concepts in finance. It's the yin and yang of finance. It's how much you can risk, how much you're willing to risk, what your return can be, and how big your return can be. Risk usually frightens off people. Most investors are risk averse, meaning they're really low risk, but that also includes having low rewards, really preserving their capital, which isn't a bad thing. They do want to preserve their capital, have more for retirement, maybe supplement their income a little bit. But with volatility, the risk increases as well. And the extreme situations with the volatility are the financial crisis and the COVID crisis. When both of those happened, the markets ended up crashing, selling off pretty harshly. A lot of investors lost a lot of money if they weren't risk averse. But with that, it's a scale. Low risk equals low returns, and high risk equals high returns. And even with sell-offs and harsh crashes like that, people can have opportunities on the short side as well as the recovery as well. The other end on return is what most people look at, and it really should be the other way around. It's in order to have a high return, you must be able to manage your risk, have a certain risk tolerance, and be consistent as well. So this is basically what investors and traders look at before they go into a trade. They want to see how much they can risk, how much reward can be, and it really determines what they're willing to risk, what the risk tolerance is, and the return they can make off of it as well. And this really depends on their time horizon. Like if they're older, they want to preserve capital for retirement, then they may not be able to take on the risk. But if they're younger, really want to supplement their income, get more financial freedom, get extra money on the side for their own goals or for their own desires, then they might be high risk and get a higher return to do that. This is why it's called the yin and yang in finance, because these two concepts go hand in hand. Before you invest, before you trade in anything, you really got to understand the parameters of these two. We do go in depth in this on our blog as well, where you can understand the higher risk, the higher reward, and vice versa. You never want to do high risk with low reward. That will always be detrimental. And in essence, there are times where you go low risk trading for a higher reward, but you really have to focus on that trade and have the mental capacity and I guess the psychological side to actually be able to have that and create that sort of scenario for you. And in reality, you must know the characteristics of a financial instrument you're trading, and that's how you build a well-rounded portfolio. Some financial instruments have high risk, some have lower risk. High risk ones might be cryptocurrency or the foreign exchange market. Lower ones might be T-bills, GICs, etc. So to talk about those asset classes, I'll hand it back to Cal Chan.
All right, thanks, Simmer. So, kind of with the asset classes, there's a lot more than what's written there. There's cash, stocks, equities, debts, which is bonds, and structured products. Throw in commodities there. But let's just kind of go on a quick summary here. So, cash. Now, cash, everyone thinks that is just a piece of paper or it's a digit in your bank account. But one thing that you have to understand is that if you live in a country that produces every single item imaginable that you need, then great, your cash is valid. But if you are a country that's like every other country, that their basis is through global trading, and each country has their own niche of producing a certain product, then you have to think of cash as more of a value relative to something else. Now, with us here in Canada, our biggest trading partner is the US. So not only am I thinking what my value of the Canadian dollar is, but what value can I get for that Canadian dollar if I'm going to exchange it for the US dollar? Another important piece is that if you're going to be investing, because for Canada, our market's limited really into natural resources, but if you really want to have a diversified portfolio, most Canadians do invest in their counterpart US markets, right? And it is the biggest in the world. So in order to buy those securities, you need US dollars. You can't buy it with Canadian dollars for a US security. It's impossible unless you go through kind of ETF, but I don't want to get sidetracked there. So kind of the cash I want you to think is that it is relative to another country's currency. It is a market that's open 24 hours, 5 days a week. Now, kind of the next is equities. Now, equities is the sexy thing. It's a glitz and glam that everyone talks about. It's the highest risk if you're looking at an asset class, or maybe besides commodities, but it is the highest risk because the return that it offers is also the highest on average. Now, with that being said, though, kind of as our previous example with a spreadsheet, that medium risk portfolio has a built-in function where it has cash in it, it has bonds in it, it has equities in it. Now, all equities portfolio is complete all equities, has the highest return, but has also the highest risk that Simar was mentioning. But stocks doesn't allow you to invest in multiple companies from a wide range of industries and sectors. So you can, in a sense, have a very diversified approach with that. Just talking about that, but you have to think of this as just a part of a big puzzle. It's just one big part, but it's not the whole puzzle in itself. Now, kind of going back to with bonds, you have a bond holder and you have a lender. So, for example, the safest bonds that you have out there are government bonds. For example, the T-bills is the U.S. bond. Theoretically speaking, as a bondholder of the U.S. and why it's safe, and we also call this in finance the risk-free rate, is that no matter what, if let's just say the US government has trouble paying the obligations, all they have to do is raise taxes. And once they raise taxes, they get enough funds to pay the interest and the obligation to these bondholders. Now, if you're thinking about more on the corporate side, what's the situation if you're a bondholder is that if for some reason those companies don't have that power of raising taxes on or raising the prices on their consumers, so if they do fail to pay that obligation, you as a bondholder has access to their assets once they do a liquidation sale or some sorts, right? So that's a benefit of being a bondholder. It's definitely a lot less risk if you're going to compare it to its counterpart of equities. Now, segue into ETFs. Main thing with ETFs, because ETFs essentially, I want you guys to think of it as like a basket. Now, this basket, you can have many holdings in it. The one thing that I like to talk about, the ETF that I follow a lot is QQQ. It tracks the NASDAQ 100. So it's a derivative. But what does NASDAQ 100 kind of tracks? And it tracks essentially the underlying assets as the top 100 pharmaceutical and tech companies. So that's what it tracks, and it tracks the average price of how these equities individually move, and it spits out a number, and that's what really it's tracking on a daily basis. Now, ETFs, it's a wide range of products. It can also track bonds. It can track industries. It can track countries and all the stocks within it. So it's anything you can imagine. Probably a portfolio manager or investment company has thought of that, and they've created an ETF to meet those needs. Now, with that being said, no one does anything for free except for us. So they are trying to get something called an MER. So it's a management expense ratio. So what that is that is their fee for doing this for you. So for tracking these indexes and all this. So typically with ETFs, though, they are cheaper relative to, let's just say, mutual funds, for example, because they're more of a passive tracking. So you're looking at around maybe 0.5% to as low as 1/10% of what their tracking fees are. So there's a wide range of products out there. There's a lot of investment companies doing this and providing you these ETFs so they can be helping you create your own individual portfolios, whether you're an advisor or whether you're an individual retail investor. Now, kind of the great segue into this is that global markets and kind of what these markets mean in the overall picture of your portfolio. And I'll let Simmer take that away.
All right, thanks. So with global markets, now that we understand a little bit more about risk and return, as well as the asset classes, we got to really understand the markets, different markets around the world, the industries, and that ranges from North America to Europe to Asia to Middle East. Each of these countries and continents, they have their own specific industries that are highly volatile in them and what people trade. And you really got to understand the time horizons, like when they trade, um, different industries and markets within those countries as well, which ones are highly volatile or which ones are booming. Like, for example, right now in North America and specifically in the US, the tech industry is booming right now. And there's a lot of buys in that. We can see that with the NASDAQ going up, Tesla, with Apple. So with the global markets, we're just trying to give people a basic understanding of what they are, the industries within them, the time frames they trade in, and different sectors that are pretty popular in them, like Middle East is energy and oil with Saudi Aramco, etc. And then China with the booming industry, they have a lot of stocks and different securities and different financial instruments that investors like to trade in there as well. So with that, there are different financial markets as well. It's not just for stocks. There's foreign exchange markets, there's commodities markets, derivatives, there's cryptocurrency. They all vary in size, liquidity, characteristics, and purpose, as well as time horizons and time frames. Like in Asia, trading in Asian market would be evening time in North America. Trading the European market would be overnight in North America. And then you just kind of have to figure out when the market opens, when it closes, when all the volume is injected into there, when is a good time to trade into there, and really understand the details of each specific market. And the thing with the foreign exchange market, it is 24/5, it is worldwide traded, it's a multi-trillion-dollar market as well. And the volume is injected when each of these specific markets do open. So to understand that from a foreign exchange perspective, or if you want to trade stocks and securities, then to really understand that when the international markets open, like Europe opens, and you want to get a European stock, what you have to do, how to execute. And then with that, you need the right brokerages to actually execute in these markets. There are some pretty good reputable brokerages that let you trade these different markets. I know with the foreign exchange brokers, they do let you trade like DAX or the Shanghai Exchange, etc. So they do have those indices, not necessarily specific stocks in there. If you did want to trade specific stocks, you'd have to look into more regulated and more sophisticated brokers, such as interactive brokers. They would have a wider range of selection of different stocks and equities worldwide that you could potentially trade. And they also have foreign exchange as well. So do that research, really go into depth about brokerages. We do write that into Trading Basics as well, how to choose your brokerages or which ones are pretty reputable, have a wide range of selection of different stocks and financial instruments as well. And with Investing Basics, we do summarize it into 3 subcategories. First being risk and return. And that's pretty important when it comes to investing. It's a yin and yang of finance. Most investments and projects use risk and return as a metric, how much you're willing to risk, how much return you can get. And then the next one is asset classes. We go more in depth about the cash, stocks, debt, structured products, ETFs, foreign exchange market, maybe even cryptocurrencies, whatever comes into our mind is going to be in asset classes. And then for markets, it's the characteristics of the markets around the world, globally, their time frames, how they trade, the biggest industries in there, what's booming, what isn't doing so well, basically how to trade those markets, where to trade them, and really get a deeper understanding of those markets. All of that is in our big Investing Basics blog, where we have posts about anything that comes into our mind. And to even further summarize it, that's why we put it into subcategories. So if you click on risk and return or asset classes or markets, we'll have each videos in there explaining more detail. And anytime a topic comes to us in the live stream, or if we think of one, we'll write it in a blog post and then add it to a specific subcategory that it goes into. But yeah, thanks for tuning in to the Investing Basics video. Hope you guys have a good day.
Thanks, everyone. Take care.